Well, hello again and welcome. This is session 1 of Financial Analysis Using Excel. My name is Jeff Engelstad, and I will be your instructor for these sessions. In this first session, we're going to cover several topics. We're going to take a look at the cash flow model and the basic Proforma setup. And so really in this first session, we're doing a lot of review, kind of a comprehensive review of finance as it relates to real estate. And I think you'll enjoy it as we go along. We're also going to build a spreadsheet to do a single period ratio analysis using some investment underwriting techniques. And I think you'll find that even in kind of the most simple reusable spreadsheet, we'll find some real value. So let's first start off with something that's near and dear to the hearts of everybody who's gone through the CCIM program, would be just the generic cash flow model. And certainly all of finance is really money in, money out, and time. I have a lot of fun with graduate students and MBAs in finance, saying, look, finance is the study of money and time. That's really all it is. So at time period 0, you make an initial investment. Throughout the holding period, you get some cash flows from operation, and then upon the disposition, you'll get a cash flow, hopefully, from the disposition. And all of this happens in time. So money in, money out, and time is really all about finance. Whether that finance is related to real estate, whether it's corporate finance, whether it's the most simple time value of money type problem, or the most complex, corporate derivatives type problem. There are 4 components to the cash flow model: the initial investment, the cash flows from operation, cash flow from disposition, and a holding period. This is what we need to know to study finance. And so really what we're looking at are 4 investment questions. And those questions are, how many dollars go into the investment and when do they go in? How many dollars come out of the investment and when do they come out? If you can answer the 4 investment questions, then you can model any kind of financial situation, and you can then keep score in the way of internal rate of return, net present value, any type of financial analysis that would go along with that. How we typically look at it in the CCIM program is in a T-chart. And the T-chart's actually a very ingenious little visual device. I really like it. But some people are more visual than others. Some people are like, okay, I don't know if I get it or whatever, but I think this one really is good. And in terms of time value of money, the time value of money are the things when we're dealing with NI, present value payment, and future value. Any kind of time value of money problem can be solved using this T-bar. Now, if it's a complex time value of money problem, and we'll demonstrate some of those, you'll have to use more than one T-bar, but you can certainly solve any financial problem, any time value of money problem, using this T-bar. What I like about this in terms of time value of money calculations is the fact that the positions are fixed. Present value can only exist at time period 0. It can't be anywhere else. Present value doesn't like to live anywhere else but time period 0. Payment, in order to be payment, has to be an equal amount and has to be equally spaced throughout the holding period. That's really important. Payment needs to be an equal amount and needs to be equally spaced throughout the holding period. Otherwise, it's not payment in a time value of money sense. Future value then can only occur as an appendage to the last payment. So there you have all of the time value of money factors, NI, present value payment, and future value represented on this T-chart. Now here I've got a little picture of the CCIM financial calculator, and some of you are familiar with this. It's just an Excel-based application. In fact, it's no different than your handheld calculator, right? So take a look at your handheld calculator. You've got NI, present value, payment, and future value, all of the time value of money factors represented. Same thing on this Excel-based application, that we currently use in the CCIM program. This is a calculator application. This is a calculator application. What is behind all of this are the actual calculations, and that's what we're really going to focus on in our time together. All right, one of the other things I really like about studying finance in the world of real estate is that there's something tangible there that we can attach our study of finance to. And real estate, no matter whether it is a very simple single-tenant retail project or a very complex real estate project, the income statement and the cash flow statement look very similar. And so certainly you can add items, but the guts of it are really pretty standard. And so we calculate our initial equity. The price of the property minus any loans equals our initial equity. That's the cash out of pocket. Then we take a look at our cash flow on a before-tax basis for the first year of the holding period, let's say. Potential gross income, sometimes called potential rental income, sometimes called scheduled rental income, but it represents the amount of money that the property would generate if it were fully occupied, right? So potential gross income minus vacancy and collection losses plus other income, typically a de minimis amount of other income from a source other than rent. And so this might be a simple example in an apartment building if you've got laundry or vending or something like that. In an office building, you might have parking that's rather insignificant, and you might put that in other income. And here's an example where how you might expand this statement. If you had an office building, a downtown office building, and you had parking as a relatively significant revenue generator, then you might have income from the rental of office space. You might also have another income line from the rental of retail space, and you might also have another income line for the parking. And so really, rule of thumb for other income is it's miscellaneous, and it's not going to make or break the pro forma. So potential gross income minus vacancy plus other income gets us down to effective gross income. Effective gross income is an important number because it represents all of the money that we take in a year's time. All of the money that we take in within a year's time, with which or from which we're going to need to pay our operating expenses, our annual debt service, and hopefully provide us a return. So from the effective gross income, we'll take away our operating expenses. Operating expenses are those expenses that are ordinary, reasonable, necessary, and reoccurring for that piece of property. And I think that's rather important terminology. In order for an operating expense to be an operating expense, not a capital item, not an extraordinary expense, operating expenses are ordinary, reasonable, necessary, and reoccurring expenses. So all of the money you actually take in, effective gross income, minus all of the money you actually spent on the property, operating expenses, will equal net operating income. And anyone who's been in real estate for more than about 2 weeks understands the importance of net operating income, right? Net operating income is the income that the property will generate. Think about it this way. NOI is the income that the property will generate regardless of who owns it. Property doesn't care whether you're tall and I'm short. The property doesn't care whether you're an LLC and I'm a corporation. The property is going to produce the same NOI for any reasonable owner. That NOI then becomes such an important number because it's translated into value via capitalization rate. All right, so we have all of the income actually taken in minus the expenses equals our net operating income. That's the free and clear income from the property. Now we have an ownership expense of debt service. And annual debt service is very typically 12 monthly payments of principal and interest on your loan, right? So NOI minus annual debt service equals your cash flow before tax. Now, when we are proceeding through the rest of the sessions in this course, we're going to do some analyses on a before-tax basis, and we'll also do some analyses on an after-tax basis. And I understand it pretty much depends on your position in the world of real estate employment. If you work for a big company, a corporate real estate pension fund, something like that, chances are you deal in a before-tax world, and there's another unit of your company that works with taxes. Now, contrast that to if you are an investment broker, you probably work with individuals, and after-tax cash flow is very important to them. So we'll do some things before tax and some things after tax. I think the important thing to realize is, you know what the difference between before-tax cash flow and after-tax cash flow is? The tax, right? Taxes due. Now, so then it becomes, okay, how do we calculate taxes due? Well, there are really two ways to go about this. We can start with net operating income, or we can start from before-tax cash flow. Personally, I think that starting with net operating income makes more logical sense. And so think about it this way. If I were king of North America, I would say, well, why don't you pay tax on your potential gross income? And you would all revolt, and you'd say, oh, that's ridiculous. We didn't even get all that money. And so I'd say, okay, well, I'm a very benevolent and nice king, and so why don't you pay tax on your effective gross income? That's all the money that you actually took in. Oh, well, that'd be like a big sales tax or something. But you would complain about that too. And you would say, look, you know, it takes money to make money. We had to spend a lot of money in order to get this EGI. And I'd say, okay, I think I understand that as well. So EGI minus operating expenses equals net operating income, which is the actual income that the property generated. And so that probably would be a good place for you to pay tax. And, you know, you don't have to like it, but here, agree with this. You'd probably run out of very logical arguments at that point, except for the fact that in this country we want to encourage investment in hard assets such as real estate, and so you get a couple of major deductions past that net operating income. If you use debt to acquire the property, you can deduct the interest that you're paying on the debt. You also get to take a depreciation deduction on an asset that's probably not going down in value. The depreciation deduction is one thing on a piece of heavy equipment. I work with a company in Kansas City, and we were an implement dealer, and you take a big bulldozer out, and every time you fire that thing up, you know, it's going down in value, but you're taking a depreciation deduction on it as well. But think about your office building. Every time you set foot in your office building, that thing's not going down in value. In fact, we typically think that real estate is going up in value. It's not guaranteed, but we typically think real estate's going up in value. So we get to take a big deduction for something that really isn't even happening most of the time. So net operating income minus interest minus depreciation equals your taxable income. And note, taxable income and cash flow are not the same thing, right? So net operating income minus interest minus depreciation gives us taxable income. We multiply that by our tax rate, and we have our taxes due. Well, before tax cash flow minus taxes due equals after tax cash flow. Now, certainly you could start with before tax cash flow. Add back principal and then deduct depreciation, and you would get down to taxable income. That taxable income would be exactly the same. Now, think about it this way. This is like a Mensa quiz using the before tax cash flow statement here. NOI minus interest is exactly the same as before tax cash flow plus principal. And then I would say, okay, why is that? And you would say, oh, well, because of annual debt service. Annual debt service is made of these two things, principal and interest. Therefore, NOI minus interest is the same as before tax cash flow plus principal. So we get to the same taxable income regardless of which route we take. Some of you might be familiar with the CCIM cash flow analysis worksheet. In fact, most people that are signing up for this course are CCIM candidates or designees. And in fact, A lot of people signing up for this course are designees. And so, you've been very well introduced to the cash flow analysis worksheet. I did my CCIM. I finished my CCIM in 1987. I think I started it in 1983. I was actually quite slow getting through the program. And I remember, back in the 80s, we had the cash flow analysis worksheet. So, that thing's been around for a long time. What we had back in the 80s was the cash flow analysis worksheet and a 12C calculator and a pen, or hopefully a pencil if you were smart, right? Because this was a hand-filled out form and that sort of stuff. And I know in the program, in my courses, and I think many of the instructors do the same thing, we still concentrate on filling out this form by hand so that the student has to engineer all those calculations themselves. If you can engineer the calculations, then you're proving that you understand them. But after that, and you are in the real world and you want to automate that process a little bit, certainly one thing that people have done and that you can do is just take that very familiar setup of the cash flow analysis worksheet and just basically put it into Excel. Now this is, in my opinion, not an Excel worksheet, or it's a very minor Excel worksheet. The thing doesn't do anything, or does very little. So we started out, for example, with an income of $378,000, so we just typed it in. Well, I could have written it down on a piece of paper. And then we said that the income was growing by 2%. So I said, okay, well, let's just take every year and multiply it by 1.02. Same thing that I would do in a calculator, right? So just pretty much using the Excel sheet as a way to make it neater than handwriting, right? Because I went on a calculator, I'd say, okay, well, 378,000 times 1.02, that gets me 385,000. And if I had done 1.02K, then I could have just kept hitting equals, and I would just grow this thing right up there, like that. And then maybe some very simple equations, potential income minus vacancy equals effective income plus other income equals gross operating income, things like that. But this is certainly not a spreadsheet that is reliable and reusable. However, it might be useful. All right. So now what we want to do is get into a little discussion about underwriting ratios. And you might be underwriting an investment as a lender, you might be underwriting an investment as a potential purchaser or as a consultant or broker or something like that. And there are several different metrics that you will use, kind of a ratio type analysis, and very similar to a ratio analysis that's done in corporate finance, right? And we do all of this stuff in real estate, and depending on the market that you're in, depending on the people that you work with, and depending on the property type, you may use a lot of these, or you may use, less than a lot of these. But let's go through these and see what we think. Some that we're big on in the CCIM program. First off, gross income multiplier. I think everybody understands gross income multiplier. How many times do you have to get your PGI to equal your value? And gross income multiplier is really has a reputation of being kind of old school and kind of pedestrian and kind of not all that sophisticated. However, I will tell you, I think gross income multiplier in conjunction with a cap rate can give you some meaningful information in a couple of different settings. Let me give you a couple examples. I do a lot of teaching in Poland and in Russia. And I do some consulting and look at some things over there. Well, you know what? In especially Russia, for example, it's really hard to get information. There's not a lot of public information that's reliable. And so as an appraiser, you're looking to find the net operating income on a property so you can apply a cap rate and determine a value or estimate a value. In a place like Russia or China, places like that, it's really hard to get a net operating income. It's a lot easier to get a gross income because all you really need are asking rents and a little bit of, and a little bit of truthing for those asking rents to figure out what the taking rents are. And then you can look at something on a gross income multiple basis. Here's another one. And I think this is more specific to those of us who are, doing our business here in the United States, which is probably most of us. Let's say that you're looking at a property that is suffering from an incredibly high vacancy. I'm looking at an office building that is 40% vacant. Well, and the rents are also a little bit depressed, right? So it's 40% vacant and the rents are a little bit depressed. However, I think there's some possibility in that property. If I look at that based on a cap rate, I'm never going to make sense of it because there's 40% of the building is unmined income, and so the 60% of the income that exists, if I apply a cap rate to that would equal the purchase, the reasonable purchase price of that property, it looks like maybe I'm buying this property on a 2 cap, when in fact I feel like it's a great deal. And so one of the things that I've certainly done in a down market is let's take a look at an equilibrium, kind of a going equilibrium market gross income multiple on an office building in this market. And let's say that office buildings in this market are running at about 7 times their gross income back when the market is in a steady state. Back in the time when the market's in a steady state, regardless of what the cap rate is, it looks like the gross income multiple is somewhere between 7, 7.5, something like that. And now the market is in disarray. And it looks like we're buying this property on a 3 cap, but we're buying it on a 4.5 gross income multiple. And so, therefore, using gross income multiplier and cap rate together, I think actually can make a lot of sense. All right, we'll go quickly through some of the rest of these and maybe skip around on a couple of them. A default ratio, lenders tend to use default ratio more than investors. And this is looking in the numerator, you've got your operating expenses and your debt service, and in the denominator you have your effective gross income. So think about this. Of your effective gross income, how much of it is already committed to operating expenses and debt service? Well, that's your default ratio. It tells you how close you are to default. And so, for example, if you have a default ratio of 85%, then what you're saying is that you need 85% of what you plan to take in order to cover your operating expenses and debt service, basically in order to remain solvent. Okay? In fact, let's skip down to break-even occupancy ratio because they're very much related. And you see, the default ratio, operating expenses and debt service over EGI, break-even occupancy ratio, operating and expenses and annual debt service over potential income. Now, as an investor, I'll look at break-even occupancy all the time. I may or may not look at default ratio, and just a different denominator is all it is. So the break-even occupancy is going to tell me what percentage of my gross potential is being consumed by operating expenses and debt service, and this will give me a break-even in terms of dollars. Now, if I have different units that are rented for different amounts per square foot and things like that, it's not going to give me a physical break-even occupancy, but it's going to give me an economic break-even occupancy percentage. So those two, I think, kind of go hand in hand. Operating expense ratio is one that's a benchmark that I would look at all the time. If you sent me a Proforma and said, okay, hey, Jeff, I want you to take a look at this for me, one of the first things I would calculate is the operating expense ratio, which is basically telling you of all the money you take in, EGI, how much is going out in operating expenses. And then I'll get a ratio, 35%, 38%, 42%. Well, those numbers don't mean anything by themselves. But then the job is to put those numbers into context. And let's say that what you're looking at is an apartment building in metropolitan Denver. And you're looking at an expense ratio of 48%. And I'm saying, wow, there's something wrong with that, because I know that apartment properties in Metro Denver have an expense ratio of more of 35%, something like this. So either the expenses are too high or the income's too low, or, there's something awry with that. And so it's a great thing to benchmark to other properties within the same market. It's also a wonderful thing to look at. This operating expense ratio is a wonderful thing to look at as a trend over time. Because, people put together pro formas. You have a pro forma of the operation of this property for the next 5 years. And, all the numbers are nice and neat and all this sort of stuff. Well, one of the things I'll do is I'll calculate the operating expense ratio each year, and I'll look at it as a trend. If the operating expense ratio year over year is going down, then what that tells me is that whoever put this pro forma together has the income growing at a greater rate than the expenses. Now, of course, having the income grow at a greater pace than the expenses is certainly something that I would like to have as a property owner. I don't know if it's something that I want to necessarily believe as a potential property purchaser. And so I look at that expense ratio over time, and if the expense ratio is going down over time, then I know that the analyst that put it together has scheduled in some operating leverage. And then I know I've got a question to ask of whoever's promoting this deal. How are we doing this? How are we accomplishing this? It looks like the income is growing at an average rate of 6% per year and the expenses are growing at 3% per year. I'd love to have that happen, but how are we accomplishing that? So operating expense ratio, I think, is pretty good one to look at. Vacancy rate kind of goes without saying. Okay, what is your vacancy rate, right? Vacancy divided by potential gross income. Debt coverage ratio, or debt service coverage ratio, some people call it. This one is very important to your lender, as we all know. Right? Lenders absolutely love debt coverage ratio because it certainly makes sense. You know what the lender wants to make sure? The lender wants to make sure that they're going to get their annual debt service and that the loan's not going to go into default. And so if your NOI is plenty bigger than the annual debt service, then there's less of a chance of default, right? So that's why I say this must be greater than 1. I guess there's no law that says it has to be greater than 1, but you'd be hard-pressed to find a lender that's going to give you a loan with a debt coverage ratio of less than 1. If your debt coverage ratio, for example, was less than 1, that would mean that your debt service is greater than your NOI. And if your debt service is greater than your NOI, then there's going to be some other pretty tough conditions on that loan you could imagine. And so a typical range for a debt coverage ratio might look something like 1.2, 1.3, and this is how a lender is going to analyze risk in a way, or it's how they're going to account for risk in a way. It's like, okay, I like your project okay, but it's a little bit of an unproven market, but you've had success in the past, and so, we want to deal with you, but we're looking at a debt coverage ratio of 1.3. Whereas if you were doing a project in a market that we were more comfortable with, because of the fact that we're real comfortable with you, we'd probably be looking at 1.2. And so if the debt coverage ratio is going to go up as the lender sees more risk in the project. All right, mortgage constant is something that we'll deal a lot with in our sessions, partly because once you've calculated a mortgage constant, it's such a handy number and you can use it in many different parts of your spreadsheet. And so the mortgage constant is the payment rate on your loan as opposed to the interest rate. It's really as simple as that. The interest on your loan is the lender's internal rate of return. If I'm a lender and I lend you money at 6% interest, no points, no fees, then you know what my internal rate of return is? 6%. Well, that internal rate of return is my profit. I need you to pay at a rate greater than 6% in order to get my capital recovery, my principal, right? So the mortgage constant represents principal and interest, while the interest rate simply represents interest. And so the calculation of the mortgage constant is going to be the annual debt service per every dollar of loan. And so it's a factor. If you're old enough, if you have enough gray hair, you might remember having the Elwood tables or the Realty Blue Book or something like that. Or you might remember back in college looking in your finance class, having to look at the back of the finance book to the present value interest factor, future value interest factor, and things like that. Well, the mortgage constant was column 6 if you had a 6-column table, and that's the payment to retire every dollar of loan on an annual basis. Okay. We go to cash on cash. Cash on cash is another one that is very often calculated and certainly important to everybody, because cash on cash is looking at what is your return on your equity investment. Well, how much money did I put into this deal, and how much money am I putting back in my pocket at the end of the year? I want to relate those two things because that's definitely important, right? It is a dividend on your equity investment. I'm on a one-man crusade to get people to refer to cash on cash. On cash is the street term for what we all know as cash on cash. I just think we would all sound more like MBAs if we referred to it as equity dividend rate, right? And it's also pretty descriptive. It's the dividend that you get for the equity that you invested. I don't think I'm ever going to break the world of cash on cash. And frankly, I use cash on cash all the time myself. So anyway, we already talked about break-even occupancy ratio. Let's talk just a little bit about payback period. Payback period, how many times do you have to get your cash flow to pay back your initial investment? Now take a look. Cash on cash is something that people calculate all the time. Well, that is cash flow divided by initial investment. Turn that around, make it a reciprocal, and you end up with a payback period. I would submit to you, if you go back to your office and you say, oh, look, I'm really, taking a finance class and we're really getting into this stuff, and then you calculate something based on payback period, they're going to say, wow, what kind of finance class is that? It's somebody out of the back of somebody's truck or something. For some reason, payback period doesn't ever seem very sophisticated, while as dividend rate seems sophisticated. So I don't know. I mean, take the numbers and flip them upside down and they are sexy or not sexy, I guess. Think about cap rate. You couldn't go, I dare you, you couldn't go 3 business days if you're in real estate without uttering the term cap rate. Try giving cap rate up for Lent. It'll never happen, right? And you know what the reciprocal of cap rate would be? It would be a net income multiplier. And so start throwing down a little net income multiplier at your office, and people will look at you like you just walked in from a different country or something. You say, well, it's just a reciprocal of the cap rate. But, I guess, I don't know. Depends on which way you look at the numbers, right? Okay, so now here's what we're going to do. We are about 30 minutes in. This is going to be probably the longest of any session that we're going to have. And the reason is we need to delay some of this groundwork before we could actually build something. And the idea of this course is certainly to build some things. And so what we're going to do is we're going to start out by building a very simple single period analysis based on some given data. And then we'll do some ratio analysis. We'll calculate the ratios. And then we'll manipulate some of those ratios and find that, a single period static analysis can be very, very useful. I have been through a number of real estate market cycles in my career. And one of the things that I now am convinced of is when the market is overheated, nobody looks at single period metrics. Investors don't look at them, and lenders don't look at them, and academics tell you they don't matter. And then when the market contracts, when the market is tough, everybody goes back to the fundamentals and looks at single period metrics. And in fact, when the market gets really tough, everybody says the single period metrics are all that matter. And so somewhere between those two positions is a balance that I would like to maintain. I would like to have you maintain. Is that, what? Yeah, I'm buying a property for a holding period, and I understand that. Real estate's not a one-year investment typically. And so I understand that. And I understand that the onus is on me to project the holding period. I also know that the year one metrics are a test for solvency. And solvency is a good thing in real estate. And I don't want to leave that by the wayside. Or if I am leaving it by the wayside, I want to know that that's what I'm doing, right? And sometimes markets are that way. All right, so let's take a look at this. Here we have, and what I'll have us do throughout this course is pretty much, this is a real simple example, but pretty much this same technique. And we'll put all of our data in one area. And so, and I'll usually highlight those and shade them in gray or yellow or something so that I know, okay, those are data cells. And those cells, I just type a value in. I have a $6 million building that we're looking at. Let's say this is a flyer that just came across our desk. And we're in the market, or we have an investor in the market for an office building, whatever this might be. And here's this thing comes in at a $6 million price. It's a 50,000 square foot building. Gross rents are about $19 a foot. It's got expenses that they have in there of $350,000. It's got an 11% vacancy rate. And so here's stuff that we probably got from the basic brochure. We know that chances are we could get about a 75% loan on that property, and let's say we could get that loan at 7% interest, amortized over 30 years with no call provision. It really doesn't. Call provision is not going to matter a whole lot to us when we're looking at just 1 year anyway. But so we've got 7% interest, 30-year amortization. So now we just want to build our little spreadsheet and then perform the ratio analysis. So once we have the given data typed in up top, then we just want to refer to it. And so where we go to price there, we're just going to hit the equal sign. Everything that is not a shaded cell is going to start with either an equal sign or a function prompt. So therefore, when we change the data, the spreadsheet will change accordingly. So here's our purchase price equals the $6 million. So it's just point and click, right? Loans equals our $6 million purchase price times our 75% loan to value ratio. Therefore, our equity equals $6 million purchase price minus $4.5 million loan. All right? Now let's take a look at our income statement over time. So we go to potential gross income, and I'll tell you what I'm going to do. I hope this is not annoying, but I'm going to cut that size just a little bit so that we're able to complete the statement here. All right, so here we go. Potential gross income. Well, what is that going to equal? That's going to equal our 50,000 square foot property times our gross rents of $19 a square foot. So we got $950,000 in potential gross income. Our vacancy is a percentage of that. So it's that $950,000 times 11%. Our other income, in this case, it's 0. But since we've got a place for it up here in data, we want to make sure that we maintain a place for it down here in the statement. So we're going to just refer to that 0. Maybe next time it won't be 0, or maybe we want to analyze what is the value difference if we can get another, if we can get some other income on this property. So our effective gross income equals potential minus vacancy plus other income. So what we know is we're going to take in $845,500 on this property in the first year. Our operating expenses, this was just a number, $350,000, and that there might have been a lot of calculation that went into that number, but by the time it became a piece of data for us, it was just a number, $350,000. And so our net operating income is equal to effective gross income minus operating expenses. So we've got $495,500 in net operating income. And we've got a $6 million purchase price. Well, we could start calculating cap rate and things like that at this point. And so, you know what? Let's jump around a little bit. Let's take a look at our cap rate. our cap rate is the relationship between net operating income and the purchase price of the property. And so we've got a cap rate of 8.26%. Now, what do you do with that information, 8.26%? Is that good or is that bad? Well, it's all relative, right? It all depends. What market are we in? Where is this property? What type of property is it? You know, what are the other properties like this selling for on a cap rate basis and things like that? And so this isn't a cap rate. It's certainly easy to calculate, but you'd spend the rest of your life understanding it, right? And so we have to put it in context. And let's say, for example, I'll tell the story as we go through this. Let's say that that's perfectly acceptable. That's about right. Buildings like this are trading at about an 8.25 cap rate, and I'm guessing that that's probably how this thing was priced, based on its income and an 8.25 cap rate. So that's $6 million. That's right in the wheelhouse for this income. Makes a lot of sense. Okay? Now let's bring some of this other information down. We've got our equity required of $1.5 million. We've got our loan of $4.5 million. And now we can calculate, let's calculate our monthly payment, because in order to calculate our annual debt service, we really need our monthly payment. Every time you build a spreadsheet, by the way, you're going to build certain limitations into it. And sometimes they don't even require a thought. And other times you might want to make note of them. But for example, we're going to build a limitation into this thinking that the mortgage is going to have monthly payments. You know what? I don't think that's much of a limitation. And so, but our annual debt service is going to equal 12 monthly payments, not one annual payment. Okay? So let's calculate the monthly payment. So for that, what we'll do is we'll grab the function. So we're not using equals there. We're going to grab this function, and we want to get the function payment. Now, what will show up is what you've used most recently. Well, let's say we haven't used much most recently, and so we'll type in PMT for payment and hit go. And there it is. Oh, look at that. It's bringing up all of those financial arguments, right? Payment, present value, interest, future value, and N. All right, well, that's cool. Let's do payment. So it asks for the rate. And look, if you can use a calculator, you can use Excel. Because you see these function arguments for the function payment? They're time value money keys. That's all they are, right? So no problem. All right, so here now we want the rate. Now again, we want to refer to everything. We don't want to type anything in. So let's go up and grab our rate. It is 7% interest. But it's monthly payments, so we're going to need to divide that by 12. Now I typed the number 12 in there. Typing a number in a function argument can be dangerous unless it's the number 12. And therefore, it's monthly. If we ever cease to have 12 months in a year, we're going to have to change all this stuff. But that's pretty minor risk. Number of periods. I have to maintain consistency between N and I. So here's our number of periods is our loan amortization times 12. So 30 years is 360 months. Present value is our loan amount. I'm going to make it negative so I get a positive result. I just like a positive result. And there we're going to have our monthly debt service of $29,938. Now notice, you have to maintain consistency between N and I. And we know that from using a handheld calculator. However, on a handheld calculator, you can set it to 1 period per year, or you can set it to 12 periods per year. And when you set it to 12 periods per year, it maintains that consistency in a little more automated fashion. Excel doesn't do that. And in fact, when I teach students at the university, when we start with a calculator, I tell them, look guys, keep it on 1 payment per year and maintain this consistency between N and I by yourself. And it's like, oh, why do I have to do that? That's another step. It's like, yeah, but you know what? When you get to Excel, it'll be that's how you have to do it, right? So you've got to maintain that consistency by yourself. All right, so we'll click OK. Now there's our monthly payment of $29,938.61. And if we wanted the annual debt service, we could just say, okay, well, that is equal to the monthly payment times 12 months in a year. So there we've got our annual debt service. We can finish up the statement here. NOI minus annual debt service equals cash flow before tax of $136,237. Now I've got another very common metric. I'm putting in $1.5 million and I'm getting out $136,000. So what does that look like as a return? And that is going to be our cash on cash rate of return, right? So I got 136 out divided by, I put $1.5 million in. I've got an equity dividend rate of 9.08%. Again, is that good or is that bad? It depends where you are. It depends what time you're in. It depends what market you're in. It depends what property type you're looking at and things like that. So I'll tell the story. Well, let's say, well, yeah, that 9's not bad. If it were 10, I've got an equity partner that would go with me on this deal. If it were 10, I got someone who would go with me. And if it were more than 10, I got multiple people who would go with me. At 9, I don't know, it's looking like a kind of an average market deal, whatever. And I'm going to have a hard time finding someone who will get really excited about it. That's just the story I'm telling to go along with this. Okay, so now our annual debt service. You know what let's do here? We know what it is. We know it's $359,263. And so we could just say, okay, it equals that. And there it is, $359,263. But you know what let's do? Let's get rid of that. And let's calculate it. And say, well, you know what? That's going to be a payment function again. And what are we going to use for that? Well, here's our 7% interest rate divided by 12 months in a year. Number of periods is our 30 years times 12 months in a year. Present value is our loan amount of $4.5 million. And of course, we solve back for the monthly debt service. But we can go outside of the function arguments and into the formula bar and edit it and just say times 12. Now we're going to get that same number, that $359,263, right? Same. Okay, let's take a look at the mortgage constant. Now remember, the mortgage constant is the payment rate as opposed to the interest rate. So it represents principal and interest, not just interest. We know it's a 7% interest loan, but let's see what the payment rate is on this loan. Well, if it's a payment rate, let's use the payment function. Take that payment function. Here's our rate of 7% divided by 12. Number of periods is our 30 years of amortization times 12. Now, for present value, we just want to use $1. Now, what this means, we can interpret this 0.00665 as the monthly payment on every dollar of loan at 7% interest and 30 years. And what I want to do is multiply that simply by 12, and I have my mortgage constant, or my annual debt service constant, which typically is not represented as a percentage like this. Although I don't know why, because sometimes I think it makes more sense. A 7% interest loan paid over 30 years needs to pay at the rate of 7.98 in order to pay interest and principal. Usually, however, when you look at a mortgage constant, it's going to look like just a decimal fraction and 5 decimal places. It's a precise scientific type number, right? And when we're in Excel, this thing's being carried out to about 30 decimal places. And so it's incredibly precise. Excel has engineering type precision, and we are not building bridges. We're building cash flow statements. And so we don't really need all that precision, but it's really nice because everything comes out well. All right, so now let's take a look at our operating expense ratio. Operating expense ratio is the relationship of the operating expenses and the effective gross income. And the operating expense ratio on this deal is 41.4%. Now, as we're going through and we're doing this ratio analysis and telling the story, let's say that thing jumps out at us. And they're like, man, that is high. That operating expense ratio, we're running properties like this in this market, at 35 to 38% for operating expenses, and yet this one's coming in at 41.4. Now, when a ratio is out of balance, it either signals a threat or an opportunity. We don't know whether this is a threat or an opportunity at this point. We just know there's something there that we need to take a look at. We're running properties at 35 to 38%. This one's at 41%. That means that on this particular property, there's something wrong with the relationship of income and expenses. Well, since I love ratio analysis, right? It's only two things, income and expenses. Guess what? One of them's too high or one of them's too low. Otherwise, that's the only way this thing gets out of whack, right? All right. So we'll put that one on hold for a while. Now let's take a look at debt coverage ratio. Debt coverage ratio looks at the relationship between the net operating income and the annual debt service. Note, the lender wants you to have a lot more net operating income than you owe in debt service because that gives the lender some security, some peace of mind, some cushion. And in this case, probably way too many decimals on that guy, 1.38 debt coverage ratio. Well, I would look at that from an investor point of view, and I would say, wow, at a 7% interest rate and 30-year amortization, we're able to cover the debt at 1.38 times. That means we've got $1.38 of net operating income for every dollar that we've committed in debt service. So that looks pretty good. That looks pretty safe from an investment point of view, and the lender's going to like it because their requirement's probably 1.2, 1.25, and so we will have exceeded their requirement. They probably won't give us any more than a 75% loan because maybe they're stuck on that 75% loan to value ratio, but that's fine. But so that looks good. The cap rate looks good. The cash on cash looks okay. The debt coverage ratio looks fantastic. Now let's take a look at break-even occupancy. I like break-even occupancy, and this is a two-part numerator, so we're going to have to open parentheses. And what we've got is everything that goes out the door. Well, what goes out the door? Operating expenses and annual debt service. Close the parentheses, and then we'll put in the denominator. What do we have to pay all that with? Our potential income. Pretty simple. Okay, so at about 75% occupied, this property breaks even, and we maintain solvency. We're not making a bunch of money, but we're not having to dig in our own pockets to pay bills, right? So and so now let's take a look at that in relation to the vacancy rate. Well, the vacancy rate on this property is 11%, and so we've got some room, before we become insolvent. And we could take a look at our payback period if we wanted to. And remember, this is just the reciprocal of the cash-on-cash rate of return. And so what we're going to be looking at here is our equity investment divided by our cash flow. So how many times do we have to get our cash flow to equal the equity investment? And certainly we would assume that the cash flow is going up in time, increasing over time, and things like that. But if it remains static, it would take us 11 years to recover our initial investment in a completely non-discounted fashion, which is okay. A lot of people look at that, and I support that, looking at some things in a non-discounted fashion as well as looking at things in a discounted fashion. So the investment looks kind of okay, except for this expense ratio. Now we're going to go back and take a look. What we said is that expense ratio, we're running between 35 and 38. And so, you know what? Let's take the top end of that. We'll just make a note out here that 38% is more or less what we're thinking is in the market. And this $350,000 in expenses is calculating out to be 41%. Either the expenses are too low or the income is too high. So we start looking. Well, what could cause the effective gross income to be too low? Two things. Either the rent is under market, or the vacancy is over market. So let's say we take a look at this. Quick due diligence. And we say, you know what? Yeah, man, I wish that this was a $21 building, but it's not. It's a $19 building. And so the rents are right. That's fine. Current vacancy is 11%. And you know what? I wish that we had such a strong market that we had 4% vacancy, but we don't. Properties that we're running are running 10, 11% vacancy. So I don't think there's anything wrong with the income side of the equation. Therefore, the expenses are too high. Well, now we need to take a quick look and say, okay, why are the expenses too high? The expenses might be too high because we're chasing problems around this property. And we've got deferred maintenance, and we're putting things together with chewing gum and baling wire that really need to be, redone. Or the expenses might be too high because somebody's not watching the contracts very well. They're just paying more for things. And so we'd have to look at this a little bit. This would be part of our due diligence effort. And so let's say physical inspection of the HVAC system, roof, parking lot, things like that, just kind of quick, cursory stuff we would do on our own. And we say, you know what? That doesn't really look like they're chasing capital items around. Now let's take a look at their books a little bit. And let's take a look at their individual operating expenses. And we can compare them to ours. And you know what? Their HVAC contract is 20% higher than ours. Their landscape contract is 30% higher than ours. Their janitorial contract is twice what ours is. And I just think that who's ever managing this building is not doing a very good job. And so I conclude, is kind of the punchline, I conclude that I could run this property at a 38% expense ratio. Now remember, what we said is that this property was valued correctly using that 8.25 cap, and we'll round it down to 8.25. And let's say that the broker that put this deal together said, okay, look, you got a $495,000 net operating income divided by 0.0825. There's your 8.25 cap rate, and that's why you're coming up with that, incredibly ridiculously precise number of $6,006,061. Let's put this property on the market at $6 million and let's see what we do. And that's right in line, and we'll be able to attract an offer on this. Well, we go through and we take a look at this and we say, you know what we think we're really going to be able to do is take our effective gross income at 38% and take those expenses from $350,000 down to $321,000. And we think we can cure that fairly quickly. When we do, we increase the value of this property from $6 million to $6,354,000. That's a pretty nice way to make $350,000. When we do that, just based on the $6 million purchase price, now here I go to my equity partner and I say, look, we can buy this thing at $6 million. It's really worth $6.3 million. I think I need a little bigger stake in this deal. Now let's take a look at what that did to some of our metrics. Operating expense ratio, 38%. Doesn't change the mortgage constant, right? Doesn't change the price of the property or the loan or anything like that. Well, look at this. It changes the debt coverage ratio because now we have more cash. And the debt coverage ratio is now approaching 1.5. I can't wait to go and talk to the lender about this deal. It's going to be so easy to do. Look at my equity dividend rate. It went from 9 to 11%. I can't wait to talk to my equity partner about this deal. A cap rate in the market now, we say, is 8.25, and it really, once we fix the operating expense problem, it looks like we're buying this property at 8.75 cap. Well, that's a good way to make money. Break-even occupancy is down to less than 72%, and so here would be just a simple example of going through a relatively straightforward single period ratio analysis and then looking for ratios that might be out of joint, figuring out why they might be out of joint, figuring out what we could, how we can manipulate that and make better investment decisions. That's really what it's all about. So one of the things, I should probably mention this earlier, but one of the things that you'll notice as we go through is here we did all of those calculations. On the next tab, you have all of the calculations as completed. And so nothing's hidden. You've got all of the formulas, everything is right there. What I would suggest very strongly that you want to do for homework is this. Go back through the blank one and complete it. And do that as many times as you need to do that to where you don't have to go to the completed one and reverse engineer. Therefore, it might take you an hour, it might take you 2 hours to get that task completed, but then you will absolutely know how to do this, and you'll know how to calculate, how to engineer all of those calculations. So we have really gone long today. This has been about an hour, and I apologize for the length of this session, and most of the other sessions will be about half this time. They're a little variable in length. This is these are not episodes of Everybody Loves Raymond, and so they're a little variable in length, but they're really kind of the sweet spot is around 30 minutes. And so there we have the session 1 of the Financial Analysis Using Excel course. My name is Jeff Engelstad, and I've been very pleased to be your instructor this afternoon, and hope to see you again soon for session 2. Thank you. Bye-bye.